Leverage ratios are often considered when analyzing fundamental data for a company. They usually consider the liquidity or bill-paying ability of the company. Low liquidity can be a signal of bankruptcy. Leverage ratios vary immensely across industries, so comparisons should be done to peers within the industry. The use of debt and equity are financing decisions that every company must make. Market and economic conditions affect the decisions as each funding source is associated with risks and costs. Long-term debt to equity compares long-term debt to common equity from the latest balance sheet. Lower is typically better since it implies that there is less of a debt burden on the company, though some debt is often viewed positively. For example, a company that has $10 million in long-term debt and $50 million in common equity would have a long-term debt to equity ratio of 20%. A company with the same level of long-term debt but only $25 million in common equity would have a much higher ratio of 40%. The first company has less debt burden and more flexibility in their capital structure, which often represents less risk to equity investors. Advantages of leverage ratios are that they are easy to compute and to understand. The ratios give valuable information about a company's operations. Disadvantages include that ratios are not comparable across industries, which can make evaluating the companies very difficult. The general trend in a ratio over time is informative. Falling leverage ratios may imply that a company's liquidity is declining or may hold other information about a company's cash management and debt levels. Viewing the components of each ratio separately can be helpful as well. If the long-term debt to equity ratio is falling, is this because the debt level is decreasing or is common equity increasing? In this example, Hormel's long-term debt to equity ratio is declining and well below its 10-year mean. A lower leverage ratio is preferred typically. Hormel's leverage ratio has declined from nearly 24 to 7, and it was 0 in some periods of 2010 to 2011. Less debt might mean a stronger balance sheet, less risk to equity investors, less leverage, and more liquidity, though some use of debt is usually warranted also.